right, so for the final session of the afternoon, we will return to tax policy. And so then following the tax policy session, we will have a reception as well. So there will be lots of opportunity to continue what I'm sure is some really vibrant and insightful conversations. And to facilitate the panel conversation on tax policy today, I'm very pleased to introduce Theo Argitis. He's the managing director at Compass Rose Group, and prior to that spent many years, 2 decades I believe, at Bloomberg, and so brings a really unique understanding of how to not just communicate policy and political decisions and what the implications of those are for individuals and businesses, but also I noticed has a master's degree in economics from the University of Toronto, where mine is from as well. So we have that in common. And so it gives him expertise as well to be able to understand the sometimes complex nature of policy and an appreciation of why it matters. So Theo, I will turn it over to you.
Well, good afternoon, everyone. We actually have the good fortune of having Jack lay out a pretty strong foundation for this conversation. And, our panelists here, very distinguished panel that will bring some policy depth, some practitioner depth, some business depth, and some academic depth to the conversation. And just to kind of set the stage further, we're just going to go around the table or around the horn here, just to have the panelists introduce themselves and share some thoughts on how they believe or think about taxation and productivity, and whether Canada's tax system is serving Canada's economy well or not. So why don't we start with Tim, just here.
Okay, I'm Tim Sargent. I'm Director of Domestic Policy at the Macdonald-Laurier Institute. I was in the federal government for 28 years, about half of that at the Department of Finance in different capacities. I was very keen to come to this session and talk about taxation because when you're trying to think about how to influence the economy, which is, the economy is very big, right? So lots of decisions, lots of sectors, lots of geography here. Taxation is one of the most important levers that the government has. And taxation is very big. So I looked up some of the numbers, government revenue, if you look at all levels of government in Canada, it's about 41.6% of GNP. And that's actually up from 40.4% in 2015, 2016. And so the system's not only big, it's also been growing. And that's particularly true at the federal level. So the federal level, since 2015-16, revenue's grown by 63% compared to GDP that grew about 48%. So you've seen the federal share has actually been growing a bit over time. And of course, the taxation systems, it's enormously complicated. And it's affecting almost every economic decision that you can imagine by households and businesses. Whether to work or not to work, what kind of work to take, how to be level of remuneration, the amount of saving that you want to do, the kind of saving, the saving vehicle that you choose, investment decisions by firms, what kind of things they invest in, just your location, whether you want to be in one province or another, or heaven forfend, move south of the border, even very personal issues like family formation, for instance, are affected by the tax system. And one of the challenges with the tax system is, you see this at finance very clearly, is it's very vulnerable to politics. And so, the people who do tax policy finance would like nothing better than to just design their perfect system and impose it on an unprotesting population without having to deal with ministers and the Prime Minister's office and all of this kind of pesky thing. But the reality is it's very political decisions. The tax system is quite vulnerable to capture by special interests. The finance minister is besieged by interest groups, 365 days a year, asking for just this little tax credit here or this little deduction there that will really, make a huge difference to them, and will be very small in terms of the cost, in terms of the great scheme of things. It's also finance ministers themselves, and we saw this, I think, particularly under the previous government, like to solve problems through a tax credit, for instance, or find little favored groups, for instance, and then give them a tax credit. And certainly, Minister Flaherty, he loved this because it was for him it was a tax cut as well as providing a tax credit to, let's say, workers' tools, for instance, or for bus passes or something like that. But it's also very vulnerable to what I would call redistributive politics. So the idea that there are lots of fat, rich businesses around, lots of fat, rich people around, and really what we need to do as a society is to find their kind of hidden wealth and then take some of it to use for various desirable social purposes. And there's certainly a kernel of truth in the idea that $10 taken from a rich person or a well-off person is not going to affect them as much as it is from a poor person. But the reality is that companies that are doing well, people that are doing well, are generally doing well for good reasons. They're generally pretty productive, and you would miss them if they were gone from your economy. And I think as well, there's a lack of recognition amongst a lot of people that wealthy people and large, particularly multinational enterprises, are the ones who are most able to alter their behavior when taxation levels are quite high. So certainly when I was at finance, we were very worried about the tax base, about the ability of well-off individuals, sophisticated individuals and companies to move things around to avoid taxation. So we've ended up with a very suboptimal system. I mean, and Jack talked about this, rates are too high, too focused on income as opposed to consumption, too many exemptions. And I think that that system is having a very negative impact on productivity in Canada. There's a growing literature on so-called Laffer curve. And this is an old idea, it dates from at least from the 1970s, but there's been over the last 10, 15 years, quite a lot of empirical work using various natural experiments. And you do see that when you raise taxes, you don't actually get as much revenue as you thought you would because of the disincentive effects of taxation, people moving income around or just working, investing less. We've been very cautious in Canada about using policy methods that take that into account. It's the so-called dynamic scoring. So the PBO and the Department of Finance do make a little bit of an allowance, but I think it's way too conservative. So just to finish off, I wholeheartedly agree we need significant tax reform, particularly on CIT and PIT. The challenge is always that, what you want to do is broaden the base, lower the rate. There will always be a lot of people, I think Jack alluded to this, who will be very unhappy about that. And so the only real, I think, political way forward is, you've got to have, it's okay if some people gain more than others, but it isn't okay if some people are really losing. And so the only way to make that work is if you're significantly reducing the overall burden of taxation. So there has to be, enough juice that you're putting into your package that you can essentially ensure that everybody's getting some sort of tax cut. And that means you're really going to have to look at how you spend your money as a government.
Tom Courchen, who I think many of you may know, once described Harper's pension for tax expenditures and tax credits as small government and lots of it. Trevor?
Great, thank you. So I'm Trevor Tombe, an economics professor at the University of Calgary and the director of the School of Public Policy's Fiscal and Economic Policy area. I'm also a proud fellow at the Public Policy Forum, so I'm ticking both of the boxes of the folks behind this great event. So in my opening remarks, I want to think about the broader structure of federalism in Canada. We're among the most decentralized countries on Earth, and so it's really hard to think about the efficiency or the impact of taxation without thinking about how federal and provincial governments interact and how we might think about improving those interactions and how we think about the interactions between provincial governments themselves. And I think we do have a lot of challenges. We've talked about productivity, no question. Another one is demographics and the pressure that creates on provincial health systems. But demographics also creates pressure on economic growth. Because if you have a declining fraction of your population that is in the labor force, you're naturally going to have lower overall rates of GDP growth per capita. And estimates vary a little bit here, but they all suggest that growth will slow in the coming years just as a mechanical result of demographics by about, to give you a sense of scale, 0.3% or so per year between now and 2050. But some provinces are experiencing pressure from demographics that are considerably higher than that national average. Some of the Atlantic provinces will see their rates of economic growth slow on the order of 0.7% per year, so more than double that reduction in growth, from a national perspective. And so we need to think about improving, first, federal transfers in a way to help provinces accommodate that growth, not just pressure on healthcare systems, but also slower rates of growth. And of course, we have one that is explicitly meant to support provinces whose economies are weaker, and that's equalization. But it's a program that is somewhat slow-moving, but so too is demographics, but itself might benefit from having a little bit more explicit incorporation of demographics in the age structure within provinces. Now, maybe equalization is not the right place to put it. Maybe the Canada Health Transfer is, adjusting that in the sense that instead of just growing it for all, we grow it a little faster for provinces that have populations that are growing more rapidly. If we don't, the effect will be that these provinces might feel the need to increase their tax rates, which are already potentially too high, in the sense that Tim noted the Laffer curve. Think about that as just revenues on the vertical axis and tax rates as you move left to right. Looks kind of like an upside down U. There's some tax rate where revenues are highest and every other tax rate has revenues that are lowest. And a colleague of mine at the University of Calgary estimates, does this fairly regularly, but estimates where that revenue maximizing tax rate might be, and finds that for all of the Atlantic provinces, for example, their corporate income tax rates are already on the wrong side of the Laffer curve, we say, and the pressure will be for that to potentially become even worse, since if one rejects the kind of empirical estimates here, then you might reject that you are on the wrong side of the Laffer curve and raise your tax rates yet further still. So I think thinking about demographics in terms of federal provincial transfers, very important. But in addition to that, we can think about how these federal structures, and by that I mean the federation, the structure of the fiscal federation, can help address other issues in terms of productivity growth. One, interprovincial trade is an example. The federal government can't do a lot here. Interprovincial trade frictions are just differences in rules and regulations that exist in one jurisdiction to the next, adding costs to businesses that want to transact or operate across those borders. And we could have the federal government withhold transfers from provinces that don't adopt policies that recognize as completely valid the rules and regulations of another. If it's suitable for consumption in terms of health and safety in one location, it should be automatically good to go everywhere. If you're a podiatrist from New Brunswick, you should be automatically able to sell your services anywhere in the country. So the federal government does have a pretty big stick here in terms of those fiscal transfers. Second, in terms of how we can think about tax reform to improve the productivity pictures, to think not just about rates and structures of it, but to recognize that it can also be used to improve investment incentives, tax rates aside. So imagine creating new tax-free savings accounts, for example, and maybe having some account that without limit you're able to contribute into for investments done within Canada, just as an example of the type of savings vehicle that might improve the investment incentives in the country. And then finally, to Tim's point, this just hit me when he mentioned it, the tax system is of course vulnerable to politics and the political dynamics that exist there. And there is a lack of a single authoritative source of analysis and insight on the implications of policy, tax policy in particular, for Canadians to digest and understand. And the PBO does good work, but I think there's space for an entity like what Canada used to have, the Economic Council of Canada, that could regularly do this kind of analysis that is sometimes awkward for governments, for sure, and that's probably why it was shut down in the early 90s, but I think important for us to kind of help cut through some of the political challenges that exist. So those opening remarks are kind of a grab bag, but thinking about provinces in addition to just the federal government, and then trying to use the tax system in a way to improve the other productivity challenges that we have.
Thanks, Trevor. Jessica?
Thanks, Theo. And before I start off, I'd like to thank the University of Calgary School of Public Policy and the Public Policy Forum for hosting such a timely and important discussion. I think we're in the right moment here. I'm thrilled to be up here with giants today to participate in today's panel with esteemed economists and tax professionals. While I'm neither, in my role as Senior Director of Fiscal and Financial Services Policy at the Canadian Chamber of Commerce, I hear from businesses every day working to navigate Canada's complex tax system while they try to plan for the future and grow their business. And that's the perspective that I'm really pleased to bring today to the panel. As most of this room would know, there's a lot of tax policy in Canada, but the overarching thing we hear time and time again from business, no matter the specific tax they're referring to, is the need for certainty and predictability in Canada's tax system. These past years, I think we can all acknowledge we've seen a significant number of changes to the taxation at the federal level. And I think the concern from the business community often revolves around tight timelines, lack of clarity for implementation, and in some cases, the retroactive nature of taxes. Businesses plan on a horizon which extends far beyond the political cycle, and to feel confident in investing and growing their business here in Canada, they really require that certainty and stability over their planning horizon, which is often very different than the political level. This perhaps is all the more important as Canada seeks to strengthen its economy, attract investment, and remain competitive in the face of potential tariffs and tax cuts in the US. In 2025, no economy is an island. The fight for fair talent, and investment on a global scale is more intense than it's ever been. And I think we'd all like to see government revenues climb to allow the government to be more fiscally responsible while paying for the services Canadians expect. Canada really needs to look away from the divisive cycle of tax and spend politics, which both of the two of you have mentioned, and instead fuel economic growth that then improves Canada's financial position, quality of life, and affordability while increasing tax revenues through growth instead of punitive measures. So there's a lot beyond our backyard right now that we can't control. I think we're all feeling a little anxious, me included, but we need to focus on controlling what we can, and a stable, predictable tax system that drives investment, innovation, and productivity is really a great place to start.
Thanks, Jessica. Fred?
Thanks, Theo. I'll aim to keep my remarks fairly high level and relatively short if I'm able to do that. Fred O'Riordan, I'm the tax policy leader at EY Canada here in Ottawa for the last 15 years, and prior to that I had a government career, the last 20 of which was at the CRA in various senior executive roles. So I was blessed when I was at the agency in the sense that all my roles were program delivery, pointy end of the stick with international tax assessments, large business and so on, and then shifting over to dispute resolution, heading up appeals and so on. So in that sense, I've got my own perspectives, but I carry with me a lot of other perspectives, both from taxpayers when I was at the agency and other tax administrations that we dealt with internationally, as well as clients of EY now. I was privileged to have been asked to speak in Calgary back in October. Kevin Milligan and I did a tax policy panel together there. And one of the things that I stressed there, and I want to re-stress here, is that tax is important, but it's not sufficient in order to tackle the productivity problem. Our productivity problem is complex, and that's why it's a good thing to have the six-city tour and so on and focus on specific buckets of issues and so on, including tax. The main thing that's happened since Calgary, obviously the elephant in the room, is the Trump election and the tariff threat. And so it's become more of an imperative, and I'm with Jack and others in the sense that that's a good thing because necessity is the mother of invention. And the biggest enemy in my experience of good tax policy is politics. Monetary policy runs very smoothly in Canada. We have an independent Bank of Canada. There's very little, if any, political interference because it's politically dynamite in order to do that unless you send a directive. Contrasting that is fiscal policy, including tax policy, which is purely political. I mean, we economists can and have studied taxes forever. We know what's good, we know what's bad, but the opportunity to implement these things is limited to the extent that they're politically saleable. So right now we're living in a good time, a scary time, you know, as Jessica said, but it's a good time in the sense that that silver lining is maybe we will be, you know, able to realize some of the reforms that we need. The bad part of that, to me, and others I'm sure, one of the main attributes of Canada as an investment destination, and that really is the crux of our problem. You can cut and slice it different ways, but it's basically our productivity problem is a function of too low a capital to labor ratio in this country, and declining, and the gap widening with other countries, particularly the United States. And by capital, I don't mean just bricks and mortar. I mean intellectual property and the whole thing that workers need, especially in a service-based economy where we do have a comparative advantage. We don't have a comparative advantage in manufacturing, for example, but that's where all of our tax incentives are sort of loaded. It's kind of weird. And again, I attribute all of that basically to retail politics, the retail politics approach to tax policy. So it's going to be interesting in the next little while. With Trump's tariffs threatening us, 25% across the board, 10% energy. Personally, I don't think that that is going to happen. I still think that that's leverage. But what I do believe is we will have some level of tariffs, and he's already imposed 10% additional tariffs on China. He's threatened, you know, the retaliatory tariffs in other areas, including Canada and so on. He's identified VAT, which we have, et cetera. So we're going to get hit with something. And I think the main question will be how high the rate is, how wide the base is, and how sustainable it is. Because when we countervail, all hell's going to break loose, or shit will hit the fan, or whatever terrible expressions I shouldn't use on a public forum and so on. It will be painful for both countries. And it's a question of, you know, politically just, you know, what will bring it all off. And there could be a scenario where it's very short term and we're back to normal. And even with the election cycle federally, we don't know what the outcome will be. The polls are too close to call right now. We could end up with another minority government, which to me would be the worst case scenario, because then there's less likelihood that they will act. We need to have a government with a big majority and a mandate, because then they'll be brave enough to actually take some risks, you know? And I'm not sure anymore I was sure that was gonna happen a couple of months ago. I'm not sure about anything right now. So in a funny way, the best case scenario for the status quo is big tariffs, short term, back to normal. But that's the worst scenario, because we won't get anywhere. We'll be sitting here next year at another conference talking about, you know, tax reform. Anyway, that's longer than I should have taken, but that's sort of my sense of the big picture.
But when you mention politics, I mean, in Greek, policy and politics, it's the same word. So I'm just going to stay at this section of the panel, talk about complexity and how much Canada's tax challenges kind of reflect complexity and costs of compliance. Jessica and Fred, I'll question to both of you.
I think significantly, and I'll tell you a little story. So interestingly, with the SHRED program, it's quite interesting in talking to businesses about this. Theoretically, this should be something that businesses are quite happy to avail themselves of. It's a tax credit. It should be a big win, a positive for everybody. But actually what we heard from businesses is it is so complex and so complicated to apply, and that CRA doesn't necessarily have the tools to evaluate what is a new and innovative product. That the concern is that they're just going to end up in an audit process. And so I think that's just a great example of how we see, we can make tax in a vacuum, but at the end of the day, businesses have to feel confident that when they apply for these kinds of tax credits, they're going to get them. And that affects their long-term planning and growth. So I think, if there's a theme that I'd love to leave today with is really the importance of not just the tax policy, but how it's implemented, and the regulatory process that's around it is really critical for it being effective.
Yeah, just building on what Jessica had mentioned, SHRED as an example of, good tax policy can be defeated by bad tax administration. That's something that I've said for some time as well. Also on SHRED, I've been around long enough to know that the SHRED program is kind of interesting, because the pendulum has swung back and forth on that program between finance and the CRA, where for the longest time at the beginning, it was viewed as as an incentive program. And so it had a light touch in terms of CRA audit activity and so on. And then there was concern about abuse, and it became a compliance program, and the CRA had to double down on audits and so on. And then sort of, so you know what I'm getting at. It's difficult for businesses to follow that and know whether, they want to avail themselves of this program or not. I wrote a piece back in 2018 for the Canadian Tax Journal on why we need comprehensive tax reform, and I identified the good attributes, the attributes of a good tax program, and one of them was simplicity, and I described it as the holy grail of tax, meaning we're always chasing after it, we'll never catch it. Simplicity, I've kind of given up on. Tax is complicated, so the best you can do is to try to put in place mechanisms for individuals, especially at the low income scale, who depend on the tax system because benefits are delivered through it, to assist them and make their process as simplified as possible. Large businesses, it's far more complicated than that, and it's not getting better, it's getting worse. And that's why, if Jack might have left for his flight actually, but I do wish him well for the big picture tax reform, and in particular one where you can do it in a way that kind of eliminates the losers or minimizes those and increases the possibility of comprehensive tax reform. Just to illustrate, for those of you, the tax geeks out there, and Department of Finance people may be here too, I mean, the Eiffel rules that we're currently dealing with, you wouldn't believe how many hours and hours have been eaten up trying to understand them. Lack of direction and guidance from the CRA, lack of appropriate forms, and the reporting requirements too, the detailed reporting requirements. This is to prevent income stripping, okay, and to limit interest deductibility. All good. I mean, this is all part of international tax reform, BEPS 2.0. Canada's in the pack and consistent with our approach and so on. But for God's sake, I mean, it's another example of the emphasis we put on corporate tax is, I hope, can be reduced. I mean, it's to the earlier comment about, which taxes are bad taxes. The corporate taxes, the corporate income tax is the baddest of the bad, and it's the tax that the CRA focus most attention on. And if you watch budgets over the last 10 years, every budget has been, the wealthy don't pay their fair share of tax, and the large corporations offshore their income, and they're evil, and we're going to allocate another $1.5 billion to the A base of the CRA in order to tackle this. And they justify that by saying, finance does in the budget, there will be a 1-to-5 ratio return on investment from this. And that's true in the short run, because it's easy to do, especially for those large corporations. It's basically done through transfer pricing, and transfer pricing methodology means it's arm's length principle. There's a range of right solutions, not one single one, and the agency will pick the most favorable one for it. It'll get reassessed. It'll go to objections. The large corporation has to pay 50% of their tax up front, the only taxpayers identified, in order to, like everybody else, all of us, it's a right as a taxpayer to decide whether you want to pay your tax when you object, right? You can pay and stop the interest clock, no risk if you lose, or you can take your chances. If you lose, you'll pay interest. But large corps are treated differently. There's all kinds of examples, and I won't go through. I'll talk too long if I do that. But it's too complicated. It's not neutral. It is distortionary. It's just a terrible tax. So to the extent that you can move some of the emphasis away from that, far better.
Question maybe to both Tim and Trevor. We were talking about SHRED. Do we need to distinguish between kind of investment tax policy and innovation, or investment innovation? I mean, do we need to think about innovation separately when we think about corporate taxation?
I think that distinction is quite artificial, really. It's becoming even more so. I mean, a lot of what qualifies as actual productivity growth is often not necessarily developing new technology, but it's adopting a new technology. A lot of new technology is adopted, is embodied within a new software system or a new little gadget, and that's actually where most productivity gains come from. The shred has created a bit of an artificial situation where you have companies locating the R&D in Canada, but then the rest of the operation is located elsewhere. Yeah. And companies now, it's very easy for them to do. So the rationale for the R&D credit has often been based on the idea that there'll be spillovers. So if we're doing a lot of R&D here, that will spill over within that particular location. I'm not persuaded that that is particularly true. To the extent that it's true, it's probably spilling over not just in the immediate location, but all across the world, particularly to China. And so then the question is, why are you subsidizing R&D that is then benefiting people across the world? So I say no.
Yeah, I'd say that question links into the idea that Jack put forward in his keynote too, that your answer to it will depend on the structure of the corporate income tax itself. And if we do shift to what he put forward as one of the big bang options there, was just taxing the distributed profits of a corporation, then you don't need to worry about what they're doing with any funds that they're putting back into the business operations themselves. And so I think that's another beauty of it that also simplifies. Potentially considerably the tax code itself. And I agree with Tim about one of the benefits of R&D are the spillovers that are created with it. And I tend to think the right way to, and that could be a market failure. We may be under allocating resources to that activity because the benefits do flow to others. But one of the ways of addressing that, rather than through the tax system itself, is through competitive granting councils like NSERC, as one example, where you have researchers competing for funds and you have it adjudicated arm's length by committees with expertise in those areas, and then we allocate those funds based on the best idea that's put forward. And so that may be a superior way to address the market failure itself.
We've seen...
Can I just add to that too? I mean, we spend, if you look at budgets over the last number of years, you can't find a budget that doesn't have lots of spending on innovation. Innovation has been a theme for a long, long time. Either direct subsidies, supports, tax credits, and so on. That's all, and yet we have a productivity problem. So to me, the evidence is whatever money we're spending there, we might be better to reallocate and do it differently. And at least in the fall economic statement, not only did they reform the SHRED program, or proposed to, it's dead now, of course, with prorogation, but they also, they launched a couple of consultations a year ago, January, one to reform SHRED. We saw some results from that. One to adopt a patent box regime. And as a firm, we submitted support for those with submissions, and the fall economic statement promised that there would be a patent box regime. Well, of course, all bets are off now. But what I like about it in particular is that it to the point I raised earlier about are large corporations offshoring their income? Well, some of them are, obviously. They're putting their IP into a low-tax jurisdiction. It's rational behavior on their part. The patent box regime has been adopted all through the European Union, everywhere. To Jack's point, Ireland as an example of a smart tax system. Almost all the EU countries, there are probably 24 of them, I think, that have a patent box regime. And we've advocated for that for 12 years or so. Finally, there's a recognition in that document that we have a productivity problem and we should do something about it. The patent box advantage is that it gives you an incentive to keep intellectual property here, and it's defined broadly, not just patents, all kinds of software and so on. And yes, you qualify for a very low tax rate, but at least it's here and it's commercialized here. That's part of the requirements any of these jurisdictions have. So we can do things under the existing system without, big picture tax reform, and do better getting away from innovation, but more to productive uses of IP.
And I think it's just important not to throw the baby out with the bathwater, right? So the SHRED program has undergone, a lot of history, but I think at the end of the day, the point still stands about the stars needing to align, right? It's not just about the incentive; it's about everything that goes around it. Why is that leaving Canada? I think we need to ask ourselves those tough questions. We hear from businesses a lot, and it's because our patent and IP regime is slow compared to other jurisdictions, or there's all sorts of other problems around it. And so I think what's important is to really drill down on that and figure out what is the actual issue and why is that the case. It may not necessarily be that the policy itself is bad. There might be other things around it that can be fixed.
I'm going to get to a question from the audience that has 4 votes. I guess that's good. So I will get to that. Time is flying here, so maybe not for you, but for you. There have been lots of talk of automatic tax filing. Should any major reform of Canada's tax policy have automatic tax filing for individuals as a means of simplifying tax administration as a goal? Anybody want to take that?
Yeah, I kind of think it's a no-brainer to proceed as much as possible with automatic filing or automatic filling, which we have. Automatic filing itself going through a pilot right now. Anything that makes it easier to pay your taxes is itself an improvement in the system itself. Part of the cost of your taxes is not just the amount you pay, but the amount of resources you put in to actually completing and complying with the tax code itself, which obviously considerable for many corporations and businesses, but also considerable for individuals. Just thinking about what's the value of the time that's being spent that could be used otherwise, whether it's for economic pursuits or not.
Maybe I'll just add to that. I didn't grow up in Canada, I grew up in the UK, and when I moved over here, I was very surprised to see these little shops that are actually selling kind of tax services, like come and get your tax return done here. In the UK, I mean, if you're above a certain level of income, and you may need to fill in a tax return, but the idea that your tax return was so complicated that most people would need to pay someone in order to prepare that firm, even if they were just like an ordinary person or like not even a self-employed person, is very foreign to the UK. So I think that we do have a system that is very complicated for ordinary people to navigate, and we should be at the point now where we could just automate a lot of it for 90% of people.
All the information is there on my account if you open my account. I mean, the agency can do that. So it is a no-brainer. I wouldn't waste too much airtime here talking about it. But the one thing I would add is, I mean, part of the problem is there's no tax literacy in Canada. There's no financial literacy in Canada. So it's a different conference for a different purpose. But for God's sake, why don't we teach more of this in our school system? We have a highly educated workforce, but nobody knows anything about how to fill in a tax form. Right?
I think just picking up on some of the earlier points and your point, that goes back to the politicization piece, right? If people don't understand, I think right now there's a sense that corporations are not helping Canadians better their quality of life or providing great opportunities. And I think that's a misnomer. And I think that we need to further the understanding that the way that we actually get ahead in terms of the services that we all want, like healthcare and other things, is by growing our economy, and that returns more money back into government coffers to spend on those things that we all really love and rely on.
I'll take one more question here from the audience, and we'll actually get a direct question after this. We've talked about reducing tax rates. If the federal government reduces income tax rates, personal or corporate, what is preventing provinces from moving into that space? We've seen that before, I think, with the sales tax in Quebec. That's taken up that the GST cut. I think it's Harper, I guess. Anyone want to take that? Is that a problem?
Well, there's nothing stopping a province from raising its tax if the federal government lowers its. There's nothing that would stop a province from raising its tax if the federal government doesn't, and there's nothing to stop a province from lowering its tax if the federal government also lowers its tax. These are two separate and independent jurisdictions, and voters in each will engage with their governments around the merits of such a change. But if it makes sense for the federal government to change tax rates, maybe some provinces would move into that space and maybe others wouldn't. But that itself shouldn't be a barrier, because it's also something that is not directly controllable by the federal government. I think provinces have constitutional authority in different areas to levy taxes, but may be able to touch on issues like how we design the fiscal arrangements between the two orders of government. If the federal government wants to lower taxes and wants to stop any province from moving into that space, then we can have a federal transfer that claws back from a province in a particular way that deviates from a tax rate of X. That would depart from how we approach federal provincial transfers typically. There's a lot of respect for provincial autonomy built into those transfers. But in principle, we could have one that claws back from a province that raises its tax as a way to provide a stick to prevent that very outcome, if indeed we wanted to do that.
And you know, if we do have comprehensive tax reform, it would have to be done in coordination with the provinces as well. I mean, those are the key stakeholders. It's not just the feds alone. So that in itself, that process would guarantee consensus around the direction and the rates and the splits and so on. But beyond that, I would say there has been tax competition in this country, but it has been very limited, and it's only been as examples on excise duties. Alcohol and tobacco over time, especially in the 1990s. If you remember, Michael Wilson increased excise duties on tobacco. I was the Director General then at the time who was faced with this huge spike in smuggling and so on. And for a couple of years we had massive smuggling, and then it was done in coordination with the province's joint reduction, because there was definite competition there. And in alcohol, federal government basically vacated a lot of space. But most of it's been a lack of competition. In fact, when space is vacated, again, political imperative, it's things like the small business rate. You know, they've been lowering and lowering, including Nova Scotia last week. From politically, it's appealing to do that. GST, HST, same thing. You know, we know it's the most efficient tax, the least deadweight losses, and so on. We should be maintaining the level. But what do politicians do? They reduce those. They reduce those. In BC, we had harmonization finally of the sales tax until Bill Vander Zalm jumps in and makes this push that this is a terrible thing. So the federal government harmonized, brought on employees, and then within a year, it was all unraveled. And again, that was terrible for British Columbia. As we know, value-added taxes are far better to lower the cost of business, stimulate exports, and so on. But they moved in the wrong direction. So it's a funny kind of political competition. I mean, it's right. It's moving away from an ideal tax system, not towards one.
Quickly, in this country, we have, in my mind, too much of a misalignment between who raises the money, which is done more at the federal level, and who actually spends it. And that's just blurring political accountability around healthcare and a lot of other files, especially those files or those policy areas where the federal government has decided it's going to interfere, even though it has very little knowledge or expertise to actually interfere. So, I think that this would actually be a feature, not a bug, and pushing more of the revenue raising to the provinces so voters can actually think about, that marginal tax dollar, is that being spent well, would be actually a good thing.
We'll take a question from the floor.
Do I just speak up?
Yeah, I was.
We can hear you.
Oh, yeah.
There's no microphone person.
Just speak
it was
up.
Trevor.
Just speak up.
There's so many questions, but
One question.
but this is a bizarre conversation. But one of them is this. There are two ways of taxing consumption. One is through transaction-based tax systems, such as the value-added tax and so on. The other way is that you can tax it by looking at income minus savings. And I would argue that anybody who doesn't max out in their RSPs and TFSAs is paying consumption tax to the income tax system. So we have, for most Canadians, and maybe you can correct me, we actually have two broad-based consumption tax systems. And it'd be nice to eliminate one of those. That would be a productivity booster. And I would argue that the income tax system as a consumption tax is a far superior consumption tax. And so this emphasis on getting rid of income taxes and going to value-added taxes, I just don't understand. And if there aren't enough people who are maxing out on their RSPs and TFSAs, just increase the ones. So, I don't understand. I don't understand that. But there's lots of other stuff that it just doesn't make any sense either.
Liquidity constraints on that one.
Well, if the question is Do I agree with your observation there? 100%. 100% I do. And I guess I didn't lean into it in my opening comments too much at all, but increasing the number of potential savings vehicles that exist to allow you to contribute into them and deduct from your income for tax purposes makes a lot of sense. And so the one I put forward was one tied to whether you're investing in Canada or not, with no cap whatsoever. And so ways of increasing the number of savings vehicles that exists in order to invest tax-free absolutely transforms the personal income tax system into a consumption tax system in a politically sellable way.
I guess maybe just to, and I largely agree with that. I mean, and Fred may have different views though. When it actually comes in practice to getting hold of that money, the nice thing about the consumption tax is it's an opportunity to catch the money that has been avoided being taxes.
Empirically, that was the argument back in 1980s. But if you look at it empirically, the collection costs far outweigh the
Yeah, and that's a fair point. And the other thing I think often people don't also realize what their marginal tax rates actually are, because if you look at not just when you've earned the money, how much you pay, but then when you go out and spend the money as well, you're adding some extra to that. So a lot of people are paying more than 50% tax on what they earn because of the combined impact of these two taxes. But I think again, like a lot of people don't see that. And when you're in the tax business, in the tax collection business, you'd actually rather not that people see the full impact of the tax system, because then they might just stay home.
Question on whether we should have two tax systems in Canada. One that is much more simplified for the vast majority of middle class and low income Canadians versus another system for high income complex situations. I'll also add to this question because I want to get to this before we run out of time. Canada's marginal income tax rate of 54%. Are we seeing any kind of impact on our ability as an economy to attract or retain talent?
Yes. Absolutely yes. I can tell you, just from anecdotal conversations, talent, I think, is one of the things that Canada sets Canada apart. We have incredible talent here in this country, including in technologies that are emerging, quantum, AI. We've got fantastic clusters, and the reality is, people will look elsewhere for a variety of reasons, but tax is one.
Well, just a quick answer to the first one. That was Jack's point with the simplified tax credit system. And then you yourself opt into one or the other. So I'll be fascinated to see when that paper comes out.
Also his point about having better data, departure data to really be able to analyze this and just see to what extent it is a problem, because all of us have anecdotal experience with it. We all know people that have left. And as Jack said, on exit surveys and so on, or arrival surveys in the U.S., tax is significant, and it's most significant for the people that we want to keep the most too. When you have marginal tax rates north of 50% in 8 of 10 provinces, that's a problem. I mean, those rates are too high, and they're not raising that much revenue. They're creating an incentive for people to avoid tax. They're creating a tax avoidance, tax planning incentive. The higher those taxes get. But to me, the worst problem is the threshold level of income at the top, 250K Canadian. It's ridiculously low. There's no other country that has a threshold level that's that low. You can't call that a wealthy individual. You might call it a high income individual, but it's political kind of manipulation. People don't earn that much, and so they're happy to see that in the tax system, because a good tax to them is a tax somebody else is paying. And the more wealthy they are, the more happy they are that they're paying the tax. But they're not really paying the tax, Most of the tax revenue is in the middle income bracket. We know that. It's a bell curve. We don't have wealthy people in Canada. We have some high income people, but we have very, very few wealthy people. And they have family offices and they tax plan. So, I mean, if you want to keep more of that revenue and get in a better place in the Laffer curve, lower the rates. It's just,
And same with luxury tax, good politics, not that useful. I think I would just say as well, like psychology, I think is one of the probably most underrated pieces that I see in Canada's tax policy. So like a thing like increasing the capital gains inclusion rate. Like what I heard from folks was not that they were like that upset necessarily that the tax increase was happening, but it was the messaging around it, right? That if you're successful or wealthy, you know, you don't belong in Canada. I think that was truly upsetting and troubling, and I think that's one of the psychology of it is a really important piece that's just so discounted. What we signal to the world is critical. You know, investors take signals very seriously, and Canada needs to signal better that we are here, we are open for business, we are ready to accept investment, particularly with what's going on in the U.S. And I hope we'll get to touch, I know the time's ticking down, but I hope we'll get to touch on issues like GMT and the DST, which are also, you know, extreme challenges with the tariffs situation.
Anecdotally, hockey, because we all love hockey anecdotes and comparisons. If you've watched the John Tavares case, it's an interesting tax case, okay? To me, it illustrates the point. The Leafs loaded Tavares with a huge signing bonus before he became a non-resident in the States and came to Canada. Now the CRA has audited him, and we're going to tax court to see how that's going to end up. I mean, look, 6 Canadian teams with our highest marginal tax rates compared to U.S.-based teams, many of them in states that have no income tax, that's a competitive disadvantage to Canada's hockey teams.
Is that why we haven't won the Stanley Cup in a while?
It might be a contributing
It depends
factor.
on what team you're talking about. On the same theme, is the generational wealth transfer that's occurring a good opportunity for Canada to consider an inheritance tax? What are the effects of an inheritance tax on competitiveness? I would also add to that as well. I mean, we have seen this massive financialization of the economy over the last 2 decades. People are sitting on, you know, very large kind of asset values relative to incomes, anyways. Does that change how we should be thinking about the tax system at all? Okay, on the generational wealth transfer.
I'll have a quick go. I mean, certainly amongst the kind of tax policy crowd, there's a sense an old tax is a good tax, a tax that people know, people understand, you know, that you know kind of how to collect it, how to enforce it. Is a very different prospect from a new tax where you don't really know what some of the tax evasion strategies or avoidance strategies are going to be. If you want to see like estate planning in overdrive, you know, go to a country like the UK, which has an inheritance tax, as almost I think certainly the rest of the G7 does. And people are spending a lot of time thinking about when do I sell my house, and you know, there's a sort of a 7-year window before you die. After 7, you know, if you die within 7 years of selling it, then it's subject to inheritance tax. So there's certainly a lot of activity going on. There's a lot of deadweight loss to a tax like that. And as was mentioned earlier, do we actually have kind of the big fortunes that are going to be liable to it? I mean, I think what people have in mind here is the owner-occupied housing. Yeah. And, you know, that's kind of I mean, politically that's going to be hard. You could argue that would be a way to actually get people to sell those houses earlier. So you could kind of make that argument. But, you know, setting up a completely new tax that we haven't had in Canada from scratch, like certainly the startup costs for that are going to be significant.
Similar with a wealth tax, I've argued against a wealth tax because that keeps coming back periodically and so on, and you know it would be problematic, and it's yet another signal. You know, don't come to Canada. It's a high wealth jurisdiction. We've seen the UK. We've seen other examples of this, and then you've got to rejig all the other things that are in the current system, like. You know, the Americans have interest deductibility. That's fine, but they do have capital gains on principal residences as well. So we've got to modify all of those provisions that Canadians love and they don't want to give up. So, and we have deemed dispositions of death too. I mean, there are tax consequences to dying.
But does the system incentivize financialization because we don't have capital gains taxes on housing, for example? I guess maybe that would be the counter to that. I have some more questions here. What is the potential impact of the U.S. move towards tariffs as a source of fiscal revenue as we think about tax reform in Canada? And I would add to that as well, like, do we not need to start thinking about tariffs as tax policy, like, especially if we retaliate? And is there such a thing as an optimal tariff policy?
I'll go first. I think there's a lot, like I said in my opening remarks, that we can do in our own backyard to respond to this vis-a-vis tax policy. So, we've got policies like the DST, the Digital Services Tax, which are really self-defeating. And they again, back to politicization, they sound great. Let's tax large American, multinational corporations. But actually what's happening is we are taxing the very digital services that our small and medium businesses need to grow. Do you think you can grow a small or medium business without using these digital services in today's economy? No, you just can't. And so really, who's going to pay the price for that are small and medium businesses who are trying to use these services to grow, and they're seeing increased costs for those services. And then on top of that, Canadians who are going to pay more for things like a staycation or, takeout and those kinds of things. So I think we really need to take a hard look at self-defeating tax policies, and the GMT, global minimum tax, is another one of those. So Canada has moved to implement this before other countries such as the US, and certainly the US has started pulling back under President Trump from the global minimum tax. And I think Canada should be taking steps to make sure that we're as competitive as possible here at home. That's what I would say.
Love that question. So a couple answers. The revenue implications for the United States of a tariff is explicitly being talked about by many leaders there, President included, to lower income taxes. And so making that connection is explicit there. And the potential revenues they could raise are considerable. If it's 25 on good, 10 on energy, so let's say 20 on average, if they did a 20% on average tariff across the board on everyone, then that 10-year window out to the mid-2030s would generate about $3.3 trillion. That's estimates there from Erica York at the U.S. Tax Foundation, which has been doing the greatest work in terms of quantifying the fiscal implications of these. $3.3 trillion. And think about what was mentioned earlier about the size of the tax cut bill that was passed 2 days ago through the House of 4.5. So $3 out of $4 they need right there from tariffs. And so if the motivation is to use tariffs as a source of revenue for sustained material reductions in income tax rates in Canada, it's possible. I think it's concerning in the sense that that would be detrimental even to U.S. productivity. But one important thing to keep in mind through this trade dispute with Canada is that there is an asymmetry here between how large economies can raise revenues from tariffs and how small economies can. If a large economy levies a tariff, then it has the effect of shifting the global demand for goods and services that the tariff applies to, mainly goods, I shouldn't have said services. And so if that global demand curve falls, then the world price falls. Now that means that producers outside of the large economy are in effect paying some of the tariff. So the incidence of the tariff is shifted abroad. But when a small country levies a tariff, we're not doing much to the global demand for anything. And so we're not affecting the world price. And so the incidence of the tariff lands on the residents of the small country. So if the US moves unilaterally with a 20%, 25, whatever the number is, on everything, a lot of the burden of that tariff will indeed be shifted abroad. And this links into like a research literature, very old research literature on optimal tariffs. In quotes, because it really is just about what's the revenue maximizing tariff rate. And it sort of depends on trade elasticities and other things, but generally for many goods, it's about 25%, which is interesting that these are the numbers that the US are talking about in terms of the tariff rates that they're seeking to levy. But that only works if there's no retaliation. If the world retaliates against the United States with similarly sized tariffs, then the world is pretty big, and it's going to be shifting the demand in a meaningful way, and it'll be shifting the burden of that retaliatory tariffs onto the US. And that combined US tariff plus retaliation abroad, now the US is left with less revenue than it started with before the trade war. So them raising revenue, largely paid for by others, can in principle occur if there's no retaliation. Them levying tariffs just against a small country like Canada, well, our retaliation does almost nothing. So now they're shifting a lot of the incidence of that tariff onto us, raising some revenue. The retaliation option doesn't exist. And so part of me thinks, although maybe it's putting too much on President Trump in terms of this logic, but targeting small countries with these kind of tariffs, roughly aligned with the revenue maximizing tariff rates, is a way to raise revenue and not worry about retaliation.
Maybe just to add to that, President Trump can't simultaneously use tariffs to achieve all of his foreign policy objectives, to raise revenue, and to move activity into the United States. Because if you're going to pursue a foreign policy objective, there has to be a world in which you don't impose the tariff. And if you want the revenue, then you actually have to have some imports. So this is actually a bit of a tricky game. I would say as well, to the extent that you're putting tariffs on intermediate inputs that are crossing the border, if you don't that will dry up. People won't do that anymore. And the reality is that this will have a significant, this will be felt to some extent by U.S. consumers. And President Trump was not elected to, he was elected because there'd been a significant period of inflation. And final thing I'll say is in the U.S. political system, pain reaches the head quite quickly. And I think that is still true.
I think that goes back to Fred's point, which is is this going to be a long-standing tariff, or is this going to be sort of a pressure tactic that comes in force and then is sort of backed off of at some time? So that's yet to be seen. I think it's unpredictable.
Unfortunately, we've run out of time for this session. It's been a wonderful conversation, and thank you very much. I think that I'm inviting you, Trevor, back to the podium for final remarks.
Should have thought about the timing of this a little bit better. That's a little awkward, but let me thank you for spending the day with us and exploring some of these good ideas. Thanks for experimenting with this new Q&A, QR technology. It seemed to work out not too badly, and for the great questions. Thank you to the Public Policy Forum for partnering with us on this event. And for the PPF, I'm going to invite Riaz, the Vice President of Policy for PPF, for some remarks.
All right, I'm going to keep this brief because I'm between you and a networking reception and I just saw wine roll out, so I do not want to be that guy. I just want to start by thanking the University of Calgary, Trevor, Jack for his keynote, all of your panelists, and for all of you to attend today. It's been just a fantastic experience for the Public Policy Forum. We're thrilled to have been partnering with the University of Calgary School of Public Policy on this. I've got a bit of a hoarse throat because I was cheering for Team Canada at the Four Nations Cup, and I've still not got my voice back, so apologies for that. I do want to just send regrets from our president and CEO, Inez Jabalpurwara. She wasn't able to make it today, but she sends her deepest regrets, and hopefully she can join a future session of the series. My team put together all these notes for me, and then I said, man, I'm not going to do that. I'm going to take notes throughout the session, and I'm going to try and wing this as best as I can, and I'm going to be very brief, I promise. So we're thrilled with this partnership because a lot of what the PPF is doing is exactly in the space. There's tons of complementarity between what the school's doing and what the Public Policy Forum is intending to do, which is around economic growth, productivity, competitiveness. And I'll give you a story. I've only been at PPF for 3 months. It feels like 3 years sometimes. But it's been 3 months, and I spent 20 years inside the bureaucracy. And so it's been a nice change, actually, of pace. And when I came into PPF, we have 3 major programs that we run in terms of our policy priorities. One is around Canada-US, the second is around energy futures, and the third is around life sciences. And they were running as siloed programs and policy projects because, on paper, they looked separate. As I came in, I started asking questions and saying, do we realize these are all sort of the same thing under the chapeau of economic growth and productivity and competitiveness and investment? And if that's the case, we need to rethink this policy constellation that actually exists between these various matters. And it's even more important now than ever before because of what's happening with Donald Trump and the U.S. economy and the tariffs and the tax that's being created for Canada. And so we're looking at Canada-US, for example, in the guise of life sciences and energy, and thinking about what do we need to do. It's less about Canada and US now. It's more about just Canada getting its own house in order. It's about making sure that we have a strong, resilient economy through all of the measures that folks have talked about on these panels. And part of that is also reimagining Team Canada. Team Canada is a bit of a broken system because you have misalignment between various levels of government, the business community, labor unions, academics. There isn't a harmonization of views and a sort of a common sense of purpose. Although that's starting to change. Polling has said that all of a sudden, because of what's happening with Trump, with the Trump effect they call it, Canadians are now galvanizing around this fact that there's like a national sense of urgency to do something. Do this thing that we're so behind the 8 ball on for so long. What can we do together to actually reimagine a scoping of what Team Canada could do if we were aligned and actually mobilizing a whole of society? We talked a lot about whole of government today. This is bigger than that, in my view. That this is going to require all actors across the country. We want to really think through the red tape and the barriers and all of the ways that organizations can't be productive, and really think through what those are and find resolution points for them. Another key piece of our work, which is really linked to our energy futures work, is getting to final investment decisions. How do we get things built in this country? We have a deficit. We need to build east, west, and north. And that goes into our fourth point, which is around globally diversifying our markets. And you need to create the infrastructure to be able to do that. And we had great conversations at dinner about this last night. A couple of things that resonated with me is, from today's session, there is no silver bullet. We really have policy choices we have to make, and there are trade-offs for each of these things. The thing that most stuck out to me actually was this Connor McDavid reference. So that was awesome. So thanks for that. And I liked the idea of this sort of policy nudge around women's hockey. I have a 3-year-old daughter, and that is an important thing we have to remember. The market will do what it needs to do, but these policy nudges are important ways that Canadians can interact with the system in a way that can be meaningful and helpful and create some of that equitable outcomes for Canadians. We need productivity in both the private and public sectors, and that there's this puzzle you have to put together around investment from public and private sectors, the technology, the skills, the training, the labor, the immigration, as well as a supportive regulatory environment. And we heard a lot about today the sort of uncertainty in the tax system. There's uncertainty in the regulatory environment. And when that happens, people do not invest in Canada. And we've got an investment crisis right now. It's a productivity crisis for sure, but we've got an investment crisis, and the two are linked. And so that's an important part of the call to action today. The other thing that really came up to me was this normalized trial and error. I really liked that notion. We have a risk-averse culture, and coming from bureaucracy, I can tell you there's a risk-averse culture. How do we change that so we're taking bigger risks so that we can actually do something important and meaningful and create a nation-building exercise around this, around this crisis? And we shouldn't waste this crisis. We should absolutely kind of take it on and move forward as a country, every single actor working together. The last thing I will say, and I guess this is a bit of a shameless plug, but the Public Policy Forum runs its Growth Summit and Testimonial Dinner in Toronto. This year will be on April the 24th. I urge you to come. If you liked anything you heard today, you're going to hear a lot more of it in Toronto on April 24th. And so just wanted to say, once again, thank you very much. I know Trevor's a fellow, Robin's a fellow of PPF, so we've got some really great synergies and kind of a Venn diagram of folks that are in our orbit. And we look forward to having them on stage with us in Toronto. So thank you very much, everyone. Please have a drink.